Today's video is going to be a combination of the truth and also narratives because, I imagine that you probably know that not all narratives are true, but the federal government and the Federal Reserve, they make their decisions based on the narratives. They try to sell you a story. It's, up to you whether you want to buy it or not. So it's important for you to know the narrative, even if it's untrue. Let's begin here. Last week on Friday, the CPI inflation report was released. The report says that the rate of inflation has now cooled down to 2.4%. My initial reaction was, wow, 2.4%, that's low. That's a very nice narrative. And don't worry, I'm going to get into why this is so important. The CPI inflation report shows that the rate of inflation came in lower than expected, helped by lower gasoline prices compared to 12 months ago. Gasoline prices are down approximately 8% year over year. And if the price of oil is down, then that's going to help lower costs, not just for gasoline, but for diesel fuel, transportation, energy, etc. It's a major input cost, right? And this has been a big help in keeping inflation, the rate of inflation, that number down. And of course, that's great. And overall, headline inflation came in at 2.4%. But I want you to take a look at some of these price changes, and these are year over year. Ground beef is up more than 16%. Home health care is up more than 12%. Hospital care is up 7%. Funeral costs are up 6%. Public transit is up 5%. And I just want to say that I am sure that that we're not getting any relief in insurance costs. And how about property taxes? I would love for my property taxes to go up by just 2.4%, but that's not reality. Now, I want you to understand the narrative. This is the story, again, that they're selling, and it's up to you whether you want to buy it or not. So here's the narrative. The Federal Reserve wants to get inflation down to a rate of 2.0%. That's their target rate. So listen, I understand that there's headline inflation, there's core inflation, CPI, PC, trust me, so I know this. But the Federal Reserve still cites CPI headline inflation, and I've shown multiple clips of that even at the FOMC press conferences. And the narrative is that inflation is cooling and it's getting close down to their 2.0% targets. So what does that mean? That means that inflation is now low enough for the Federal Reserve to start cutting interest rates again. But you have to remember that the Federal Reserve was cutting interest rates to save the labor markets from deteriorating, right? The most recent jobs report for the month of January showed a strong labor market, 130,000 jobs added, smashing away expectations. And the rate of unemployment fell from 4.6% in November to 4.4% in December. And now it's at 4.3% in January. So the labor market is solid. 130,000 jobs added, falling unemployment. There is no need to cut interest rates because the labor market does not need any rescuing, right? However, President Trump and the Federal Reserve, of course, they're going to want to cut interest rates. But now the narrative is going to shift from focusing on the labor market to, oh, inflation is so low, now we can afford to cut interest rates. Now, I want to show you the odds of an interest rate cuts, and this is coming from the CME Fed Watch, especially with Jerome Powell as the chair of the Federal Reserve. So he's not going to want to cut interest rates just to appease President Trump. And then the following meeting is going to be on April 29th, which is a little bit more than 2 months away. And then at that meeting, there's a 71.5% chance that they will not lower interest rates by then. So that's actually going to be the last FOMC meeting that's going to be with Jay Powell as chair of the Federal Reserve. And then President Trump's most likely new Fed chair nominee, Kevin Warsh, is going to come into power in the middle of May. And then the next Federal Reserve meeting is going to be on June 17th. And I want to show you the odds of an interest rate cut by that June 17th meeting. There's a 32% chance that they will not cut interest rates by that meeting. That means that there's a 68% chance by that meeting that they will cut interest rates. Okay, so in a matter of a month and a half, why do the odds flip by so much? So I'm talking about a 71.5% chance that they don't cut, and then a month and a half later, a 68% chance that they do cut. I would say, of course, it's because the market believes that Kevin Warsh, as the new Fed chair, will do President Trump's bidding and cut interest rates. This means that the market believes that the Federal Reserve is no longer independent of the US government, not even for optics. And I would say it's obvious. President Trump's not going to pick a nominee that's not going to cut interest rates. Otherwise, he wouldn't pick him. And it's pretty straightforward. You wouldn't hire someone that's not going to listen to you when there are other candidates that will. Okay, now I just want to clarify this. When the Federal Reserve prints money, that helps stocks and that helps precious metals as well. And when the Federal Reserve cuts interest rates, that helps stocks and that helps precious metals as well also. But I just want to say that this is not going to be the case for all stocks, especially in tech. So I'm just saying this because I don't want to give you a false sense of security from upcoming interest rates if you're picking individual stocks, especially in tech or software. And it's very important for me to address this because I'm getting a lot of questions about tech and AI. And I've said this before, I believe that in my opinion, that AI is disruptive and it is the future. To me, I see it as a new era. And in this revolution, you have to ask yourself this very important question: which companies are going to become obsolete by AI? And which companies are going to stand to benefit? And I want to cover an example, and we'll use Duolingo. And this is not sponsored by Duolingo because I'm actually going to be talking bad about them. So Duolingo, if you didn't know, it's a language learning platform. It's a mobile app, it's a website, and they are suffering. Just take a look at their one-year chart. And I'm going to share my perspective, and I think it's important because I am a person that's fluent in Spanish, and I learned it as an adult, which is, I would have been a perfect customer for Duolingo, right? Someone that wants to learn a different language. But I'm looking at this why would I pay $12 a month for Duolingo when I could just use ChatGPT or any other AI platform, and it would give me vocab words on a daily basis. It would correct my grammar. It would tell me the correct pronunciation of words. And it would go even more in depth, such as tell me this phrase in Colombian Spanish, make it sound more nea. Or tell me essential and common swear words in Mexican Spanish. Create a daily lesson plan for me. I could get this done for free with AI. It would be cheaper and it would be better than Duolingo. So Duolingo has no moat. So all I'm saying, the bottom line is that interest rate cuts may not be enough to offset the impact of AI in this particular case. And listen, I know there's a free version of Duolingo, but I don't want to see ads. And then you have a company like Amazon. They are down 12% over the past 1 year. Of course, this is nothing as bad as compared to Duolingo, right? And the market is still trying to figure out the impact of how's AI going to impact many of these stocks. And in Amazon's case, in this example, they're already using AI to make their operations more efficient. And they also have a moat. What? Okay, practically speaking, what, is AI going to magically deliver products? Is AI software going to magically create physical warehouses? Of course not. And even if a competitor uses AI to build a better shopping interface, well, they're still going to need trucks, airplanes, warehouses, inventory networks. Amazon basically has logistical and physical infrastructure moats. So listen, I just want to be absolutely clear with you. Interest rate cuts will be a tailwind for stocks. But in certain industries, I don't know if that's going to be enough to offset specific challenges or disruption in a certain industry, especially in tech. Now, in my opinion, gold is a more clear-cut story. Gold is already getting a tailwind from de-dollarization. This is from other countries preferring gold as a reserve asset. And interest rate cuts will be another tailwind for gold. So I want to give you a clear-cut example. Let's just say that interest rates shoot up to, let's just say 7%, okay? In that case, inflation would be suppressed, and then you literally get to stick your money in a savings account, and then you would earn 7%. So then that's a situation of low inflation, you get a high yield, and then you wouldn't need a safe haven like gold, and then they would sell off. But if they cut interest rates to, let's just say 2%, then what's going to happen? The rate of inflation is going to rise. You stick your money in the bank, and then you're going to get a measly 2% return. So you're going to have high inflation, you're going to have a low yield, and then you would be more incentivized to invest in gold. So gold is facing a situation where it's getting tailwinds from de-dollarization, it's getting a tailwind from money printing, and then soon a tailwind from lower interest rates. But anyways, that's the narrative. We have a strong labor markets, we have low inflation, and that's setting us up for President Trump's new Fed chair to cut interest rates, just hit the ground running.
Because it's not there to stimulate the economy per se. Instead, what they say is that this is to, quote, maintain ample reserves in the banking system. Well, let's go a little bit deeper. If it's not QE, quantitative easing, what is it? Well, according to the Fed, it is RMP. What that means is QE, or quantitative easing, is when the Fed, number one, prints money. Number two, they inject it into the economy. Two, number three, stimulate the economy. RMP, which is reserve management purchasing, is when the Fed, number one, prints money. Number two, they inject it into the economy for the goal of, number three, stabilizing markets and stabilizing interest rates. So now when you hear that and you say, wait, Josh, but that sounds kind of like the same thing, just a different way to describe it, you're right. The idea behind RMP, which is what the Federal Reserve Bank is doing, is not sold as an idea to stimulate markets. It's sold as the idea to stabilize markets, to prevent problems in markets, to prevent problems with banks, to prevent problems with interest rates. Now, whether you call it QE or RMP, the technicalities are essentially the same because it involves the Federal Reserve Bank having to create money and purchase certain assets. Because remember, while they're called the Federal Reserve Bank, they're actually not a bank because you and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash reserves, and they're actually not federal. It says so on their website. They are a separate entity. So when the Federal Reserve Bank now is going out to purchase these assets, and I'll explain what they're purchasing in just a second, they need money to do so. They just purchased $90 billion of these assets. They're not sitting on $90 billion. They're not a part of the government, so they're not getting tax dollars. So where does the $90 billion come from? It comes from the money printer. The Federal Reserve Bank is the central bank, and while they don't work inside of the government, they have the ability to turn on the money printer, create this $90 billion, and then use it to purchase certain assets. So which assets are they purchasing? They're purchasing treasuries. A treasury is a loan made to the United States government. The United States government has a very large debt problem. We have over $38 trillion worth of national debt. Well, every year, the United States government spends money that they don't have. This is called a national deficit. And when the government spends money that they don't have, they have to borrow that money so they can spend it. Where do they borrow that money from? Well, they can borrow that money from people like you and me because we can lend money to the United States government for the hope of getting paid back plus interest. They can borrow this money from foreign countries like Japan and the United Kingdom, which are big lenders to the United States government. Or they can borrow this money from the Federal Reserve Bank. So if they can't get this money from foreign countries or private investors, then they have to turn to the central bank, the Federal Reserve Bank, who then fills that gap. And that's what's been happening as a way to stabilize markets because the United States government is still spending a lot of money. They're spending more money, and they need more debt in order to keep financing the spending. And this is where the Federal Reserve Bank has been stepping up. Now, why would they do that? Because if the United States government borrow enough money, that's going to look like a problem because the United States is the world's economic superpower. The United States dollar is the world's reserve currency. And so if the United States government issues a loan that we want to borrow $50 billion, and they cannot complete that loan, that would create a lot of confusion. Why aren't people willing to lend their money to the United States government? Are they concerned about the United States economy? Are they concerned about the United States dollar? Are they concerned about other sort of uncertainty? And that could create panic, that could create stress, that could create stress in interest rates, stress in the stock market. And this is where now the Federal Reserve Bank has been stepping up to fill that void with this new $90 billion of spending, and it is planning to continue on in 2026, at least in the foreseeable future. We'll see what happens when the Federal Reserve Bank changes, because currently the Federal Reserve Bank is led by a guy named Jerome Powell. His term expires in May, and President Trump has announced that he's going to appoint a new person named Kevin Warsh to lead the Federal Reserve Bank. And Kevin Warsh has some different opinions on what needs to be done at the Federal Reserve Bank compared to Jerome Powell. So let's see what happens in May. But based off of what we're seeing today, the Federal Reserve Bank has now turned on that money printer, and they are actively working to stabilize markets / stimulate markets. Now, why does this matter? Because this can impact mortgage rates, this can impact the stock market, this can impact the value of the dollar. Let me start with mortgage rates. When you go to get a mortgage from the bank, your bank has the ability to lend this money to many people. They can lend this money to you, they can lend this money to your broke cousin Bunty, or they can lend this money to the United States government. Who do you think is considered the safest investor? It's not you. It's definitely not your broke cousin Bunty. It is the United States government, because the United States government can just tax its citizens and generate more dollars, and if they don't have enough tax dollars, they can just work with the Fed to print more money. So the United States government has the ability to pay back their debts plus interest. That's why every economics textbook will tell you that lending money to the United States government is considered a risk-free investment. So if that is a risk-free investment, do you think they should pay you a higher rate of interest or a lower rate of interest compared to you or your broke cousin Bunty? Well, if I'm going to lend money to my broke cousin Bunty, I'm not going to do it for 2 or 3% because that is a very high risk. The higher the risk, the higher the rate of return that I would want as an investor. So when the bank is looking at investing the money, they're going to pay or get the lowest rate of return from the government. They're going to want the highest rate of return from their subprime borrowers. And you, if you're a good borrower, are going to be somewhere in the middle. The reason why this matters is because the interest rate that the United States government pays is going to depend on how many buyers there are for their loans. It's supply and demand. If the United States government is issuing a bunch of loans, but nobody is lending money to the United States government, the government will then be forced to raise interest rates on their loans to incentivize people to invest their money and lend their money to the United States government. If everybody is throwing money at the government saying, here, I want to lend my money to the United States government, then they're going to slowly pay lower and lower interest rates because there's all this demand for the United States loans. Well, the Federal Reserve Bank is effectively a buyer of these United States loans. And so when the Federal Reserve Bank now buys $90 billion of these loans from the United States government, that means there's no more buyers of these loans. As there are more buyers of these loans, that can push down interest rates that the United States government is paying. That has a two-pronged effect. Number one is if the United States government now has to pay or can pay a lower interest rate because there's more buyers because the Federal Reserve Bank is just printing that money. Well, now your bank will say, oh, the government is paying a lower rate of interest, so we can even charge you a lower rate of interest because you're still higher than the government, but the government is paying less than before. So when the Federal Reserve Bank does this, it can effectively lower mortgage rates to some extent. The other part, more of a macroeconomic part, is that when the Federal Reserve Bank buys more of these treasuries and treasury rates go down, that means the interest rate that the United States government pays on this debt also goes down, because I made a couple videos about this recently. But the United States government not only is borrowing more and more dollars, but what they started doing recently, in the recent years, is they've started borrowing this money in shorter term intervals. Before, they would buy generally or issue 30-year loans. Now they're doing shorter and shorter terms, 1 year, a few months, which means now that more and more of our national debt is a readjusting interest rate, because it's not like the government is paying off their debt is growing. And so every 6 months, when the next batch of debt readjusts, it readjusts at the next interest rate. And so if interest rates are going down, that means our payments are going down. If interest rates are going up, our payments are going up. It is 100% more risky. It's great when interest rates go down. It is extremely painful when interest rates go up. And so that's some pressure that the United States government might be putting on the Fed to say, hey, maybe we need to figure out how to lower these interest rates because we don't want to keep paying more money on this interest. Because remember, in 2025, the second largest expense, just behind Social Security, for the United States government was interest payments. We paid more money in interest than we did for veterans, than we did for our military, than we did on infrastructure. Is that a problem? Well, that means 20 cents of every dollar that you pay to the government is going directly, not to you to service the country, but to just pay back old payments. So when the Federal Reserve Bank now prints this money and then they buy these treasuries, the first thing is it lowers interest rates, which can impact your retail rate with things like your mortgage rate, but also then with treasury rates. The other thing that this can impact is obviously the stock market, because if you have lower interest rates, that means institutions can also, in theory, borrow more money at lower interest rates. And if Wall Street institutions can borrow more money at lower interest rates, then they will generally borrow more money. And where do they put that money? Back into stocks on Wall Street. And again, stocks are a byproduct of supply and demand. When you have more buyers than sellers, stocks go up. When you have more sellers than buyers, stocks go down. And we have seen a lot of volatility in the stock market in 2026, up and down. We have seen a lot of volatility with gold up and down. We've seen a lot of volatility with Bitcoin up and down in 2026. And up until now, we've heard that we don't want to see bailouts, but this is an indirect way now. If we're putting money into the treasury market, we're stabilizing the treasury market, which in theory should also help. It can't directly, but indirectly help stabilize the stock market as well, because if people feel more confident about the treasury market, they feel more confident about the dollar, they're going to feel more confident about the stock market. If people are concerned about the treasury market, if they're concerned about the United States government debt, that creates volatility in the stock market. So you can see how by stabilizing the bond market, you're trying to stabilize the stock market. Although we've seen a lot of volatility in the stock market, imagine what the volatility would be like if the bond market was also going crazy. It would be significantly